Welcome back to Mastering MHA MBA. This is Chapter 11, Part 3 of 3. We have the methods. Now we feed them the right numbers. This part is about the hardest and most valuable skill in capital budgeting, knowing exactly which cash flows belong in the model, how taxes reshape them, and how to value the freedom to wait. Get this right and every method works. Get it wrong and none of them do. The golden rule is the same one from the decision-making chapter. Only relevant cash flows belong in a capital budgeting model. To be relevant, a cash flow has to be in the future, and it has to differ depending on which choice you make. Money already spent, a sunk cost, is never relevant, no matter how painful it was. And we work in cash flows, not accounting income, because cash is what gets discounted. That distinction trips up beginners constantly. Depreciation, for example, is not a cash flow at all, yet it still matters, and we will see exactly why in a moment. To build the cash flow forecast, sort everything into three buckets. First, the net initial investment, the cost of the asset plus any extra working capital the project ties up. Second, the recurring operating cash flows, the after-tax inflows the project generates each year it runs. Third, the terminal cash flow at the end of the project's life, when you sell off the equipment and recover the working capital. Get all three buckets right, line them up year by year, and you have the cash flow stream that every method in Part 2 needs. Here is a step beginners forget. Cash inflows from operations are taxable, so we have to discount them after tax, not before. If a project earns $1 of additional operating profit and the tax rate is 30%, the company actually keeps only 70 cents. Treat the government as a silent partner who takes a cut of every gain. Using pre-tax cash flows systematically overstates a project's value and leads you to accept things you should not. Always discount what the company actually gets to keep. Now the twist I promised. Depreciation is not a cash flow. No money leaves the building when you record it. And yet it absolutely belongs in the model because depreciation is tax deductible. Every dollar of depreciation you deduct lowers taxable income, which lowers the taxes you pay, which keeps cash in the company. The cash saved equals the depreciation amount times the tax rate. Accountants call this the depreciation tax shield. It is a rare case where a non-cash item creates a very real cash benefit, and missing it will make a good project look worse than it is. Let us put numbers on it. Suppose a machine generates $80,000 of depreciation each year and the company's tax rate is 30%. The depreciation tax shield is 80,000 times 30%, or $24,000. That $24,000 is a genuine cash inflow every year, money the company keeps because the deduction lowered its tax bill. You add it to the project's after-tax operating cash flows before discounting. Leave it out and you have understated the project, possibly enough to reject a winner. Remember the fifth stage of capital budgeting: implement and learn. The learning happens through the post-investment audit. After the project has run for a while, you go back and compare what actually happened to what the forecast promised. This does two things. It holds the people who made the projections accountable, which quietly discourages the rosy forecasts that get pet projects approved, and it sharpens the company's estimating for the next decision. A capital budgeting process without a post-audit is a process that never finds out whether it is any good. Two forces are reshaping how companies build these cash flow models right now: a wave of new tax incentives and a renewed appreciation for the value of flexibility. Two updates, then we wrap the chapter. Our first update is a perfect example of taxes driving cash flows. The Inflation Reduction Act, passed in 2022, created large clean energy investment tax credits. What is new is that companies can now sell those credits to other firms for cash. Treasury data showed that transfer market reaching roughly $45 billion in 2024. For a capital budgeting model, this is huge. A tax credit you can sell becomes a concrete cash inflow you add right into the forecast, often turning a marginal renewable project into a clear positive net present value. The tax code is now a line item in the investment decision. Our second update is about real options. The idea that the ability to wait, expand, or abandon a project has real value. When the future is uncertain, committing everything up front can be a mistake. You may be better off building in stages, keeping the option to scale up if things go well and walk away if they do not. This is exactly how the cloud giants are managing the AI build-out, committing in phases rather than all at once. A simple net present value calculation, which assumes you decide now and stick with it, can undervalue a project that gives you the freedom to change your mind. Two last realities. First, capital rationing. Companies rarely have enough cash to fund every positive net present value project, so they must rank them and pick the set that creates the most total value within the budget. Second, not every benefit fits neatly into a spreadsheet. A project might open a strategic door, build a capability, or protect market position in ways that are hard to quantify but very real. The numbers should inform the decision, not make it. Net present value is the strongest input to the call, but it is still managers, not models, who decide. That completes Chapter 11. You can now evaluate a long-term investment from start to finish. Net present value is your gold standard, with internal rate of return, payback, and the accounting rate of return offering extra angles. The quality of every answer depends on getting the cash flows right, future, incremental, and after tax, including that sneaky depreciation tax shield. And the process only improves if you go back and audit what actually happened. That is the full discipline of betting wisely on the future. Capital budgeting handles the big multi-year bets, but companies also have to plan the year directly in front of them, translating strategy into a detailed financial roadmap. That is the master budget, and it is the heart of the next chapter. We will build one from the top down and see how the whole organization gets coordinated through a single set of numbers. Thanks for watching, and I will see you in Chapter 12.